Vice President of Real Estate Investment and Asset Management at Sage Hospitality.
And I'm Courtney Fisher, Senior Vice President of Operations, Finance, and Accounting at Sage. And today we're going to spend some time talking to you about balance sheet and cash flow basics.
So we'll start with the balance sheet. If you have a moment and can print out your own balance sheet and cash flows and refer to those as we walk through each of the detailed components, you can then relate that back to your own property. So the balance sheet. The pure basics of the balance sheet is on the left-hand side you have your assets, which equal the right-hand side, which are your liabilities plus your equity. So we'll walk through the components of each of those.
So assets, examples of assets would be cash, accounts receivable, inventory, prepaids, and fixed assets. And the fixed assets might include areas like land, building, FF&E, and capital. Keep in mind, assets, as we'll talk about later, are really how much cash you have on hand in different forms. So it could be cash in the sense of real money in the bank. It could be accounts receivable and cash that you're going to be collecting, or it could be assets actually at your property that are actually worth something to your owners.
And on the liability side, you have your accounts payable, so all of the bills that your properties pay, your accruals, which include payroll, vacation, and bonuses, your management and franchise fees, and real and personal property taxes. Those are the main components, as well as the other large component of your liabilities will be your debt, so any notes payable on your balance sheet. Your owner equity, so again, assets equals your liabilities plus the owner equity, includes capital. So the money that the owner invested at the initial purchase of the property, contributions, so any additional dollars subsequent to that initial investment that went in, so for any operating shortfalls or additional renovations that your property may have needed, and net of any distribution, so any excess cash that your property has generated that you've distributed to your owners. Also included in equity is your retained earnings. So if you added up every year of your net income since the closing of your hotel. The other component of owner's equity is retained earnings and net income. Your retained earnings will equal the sum of all the net income of all the years since the purchase of the property. So if you go from the beginning, add up every year, that's your retained earnings. Your current year is obviously your net income from your income statement of just that year.
So now let's talk about how to check the health of your property. We talked about assets, liabilities, and owner's equity. The way for you to easily check the health of your property is really to look at your assets versus your liabilities. If your current assets are greater than your current liabilities, your property is in a healthy financial situation. Contrary to that, if your current assets are less than your current liabilities, your property is not in a healthy cash situation. So look at the balance sheet you've got in front of you now, and you can quickly see how much your current assets are versus your current liabilities. Some things to keep in mind though are, as we talked about, cash includes accounts receivable. So even though your current assets could be greater than your current liabilities, indicating a healthy balance sheet, if you have a high accounts receivable balance, that's not cash you have collected yet, and it's not in the bank. So it's really not available to pay your vendors, to pay your payroll, etc. So even though it may indicate a healthy balance sheet, you need to be very careful and ensure that you don't have too much in accounts receivable in order to ensure that you have enough money to pay those liabilities. So let's talk a little bit about the cash flow. Do you want to start, Sarah?
Sure. So starting from the top, the beginning of the cash flow is your departmental sales and your IBFC. So those come straight from your income statement and are really the start of your cash flow. Below that are your fixed charges. So those include primarily your insurance, your taxes, if you have a tax reserve reimbursement, which some of our properties do, and any equipment lease expenses.
The capital expenditure section would include the capital purchases you've made at the property and also include any reimbursement from your lender for those capital reimbursements. In the debt section of your cash flow, it would also include the debt payments you've made for the property and any reimbursement from the lender that you might have gotten to pay the hotel back for those debt payments.
So the next piece of the cash flow is typically your changes in working capital. So you'll have changes in assets and liabilities. So back to the balance sheet, what we just walked through. Changes in your assets, including accounts receivable, prepaids, inventory. I always think of it, this one's the opposite. So when your assets increase, your cash decreases. So if you have more accounts receivable, for example, than you did in the prior period, you will have less cash available to pay your liabilities. In turn, the liability side is the same. Those correspond. So your changes in liabilities, if your liabilities increase, so does your cash. So if you don't pay your bills one month, you haven't used that cash to actually expend the cash, so you'll have more cash on hand, but also higher liabilities. So the next component of the cash flow, once we've been through paying our bills, the changes in working capital, collecting our AR, paying our debt payments, making any capital purchases required, are the contributions and distributions section of the cash flow. So you'll get down to a number after all of the components that will really show you if you're either short or have cash on hand each month to either distribute, or if that's not possible, potentially ask for a contribution from your owner. So contributions will be required in cases where you potentially have a renovation or a PIP, or you have a shortfall funding. And on the opposite side, distributions, when you have excess cash, you'll want to work with your owner, have those conversations as to whether or not you're able to distribute cash above your working capital threshold in your management agreement.
Obviously, our owners would much rather see distributions than contributions.
Yes.
Much easier conversation. So let's talk about a few key takeaways that I think will touch on both the balance sheet and cash flow and some of the points we made today. Things you need to think about. You really need to think about how much cash you have on hand, how you're handling your AR collections, ensuring you're getting that money in the door as soon as possible, and then how you're able to use both of those in order to fund the timing of your AP payments or your payroll payments. All right, the final key takeaway that we want to make sure everyone understands is how forecasting ties into the cash flow. As we've talked about, it's important for us to understand when we need capital from our owners, but also when we have excess cash to distribute. We want to make sure and not look at that in a vacuum month to month, but we need to understand how that potential cash flow will look through the rest of the year and into the following year. As an example, we don't want to distribute cash in the month of March and find out we're going to need to contact an owner in the month of June and ask for that money back. So the forecasting is really critical on the cash flow to ensure that we know what the picture looks like past just a few months, so that we can talk to those owners and make sure that we've got a collective decision on what we want to do from a cash perspective. So we want to thank you for your time today in going through the balance sheet and cash flow. And I think it's important for you to understand that we are here as a resource for you. And you're welcome to call Sarah or myself at any time, or your finance leader, and ask any questions about these topics.
Thank you again for your time today. We wish you more distributions than contributions, and best of luck to you.